Hi, welcome everybody. My name is Shamin Melville. I've been with ISW for many years in many roles, and we were very fortunate this year that Mayank came forward and he proposed this idea of providing a series of seminars, which is just not seminars, but a more of a way of connecting. So this is our fifth seminar on, and we've had different topics. The first one was in general, introduction to the college application process. And now we are doing detailed ones. If you want to see recordings of the previous ones, they're on our ISW YouTube channel. So, send me a message if you can't find it. But, and we also have a College Connect group where we hope people can talk to each other about resources they're finding. So we're recording this session also. We have permission from the panelists. And okay, so Mayank, going to introduce our wonderful panelists.
Sure. Thank you, Shaminji. Thanks everyone for attending today's seminar. As Shaminji was pointing out, it's all about college admissions. We are going step by step. First was the general, then we covered essays, mental well-being, and now we are talking about financial planning today. A pretty important aspect, as you can imagine, because college, as a process is pretty expensive if you don't plan it properly. So we have a very good lineup of a couple of panelists and speakers today. We have Ms. Kanan Sachdeva. She runs a financial planning practice at Northwest Mutual. She's going to be talking about the various instruments that are available for parents and potential parents of university folks, university students, how to plan the financials better. And we have Mr. Patrick Herndon, who is a part of a college counseling team, and he specializes in financial aspects of the college admission, college management. So he's going to be talking more about how do you navigate the process and get the best deals from the colleges. So I would really like to thank both of them for their time today. And I will start with asking Ms. Kanan Sachdeva to start with her presentation, please.
Sure. So thank you, Mayank, for the introduction. Hi, everyone. I'm excited and happy to be here today. And let me share my screen first. Okay. So as we know, the topic for today is financial planning for education. So just so you know, everyone, in my practice for over 10 years, we meet with families from all across the country, families and parents with kids of different age groups, and also families who have, who have different financial situation, income levels, tax situations. So we do build very customized and structure unique solutions for them when it comes to saving for their kids' college. So it is not a one-size-fits-all kind of approach, just so you know. But for today, I'm going to keep it pretty high level. I want to give everyone, it's an informative session for parents to know what is out there when it comes to saving for college. In no means, or by no means, am I making any recommendation or product suggestions here. So just please keep that in mind. But one thing is common, whether we build customized solutions based on our one-on-one meetings, or if it is a general presentation like how it is today. One thing is pretty common, which is I always recommend parents to start thinking about some of these things much sooner rather than later. So if you have a kid who just entered high school and now you start thinking about, hey, what do I need to do for college saving? Well, it's not impossible to get it done, but I would say, if you start planning ahead, thinking ahead, all the financial concepts of saving and budgeting and compounding and time value of money would make way more sense, and it can do wonders over time. So that is one takeaway from this entire presentation would be, please start thinking and planning sooner than later. So without further ado, let's get into the presentation. So like I said, we meet with lots of people, lots of parents on a daily basis, and people have questions, right? And these are some common questions we kind of put together, like, hey, will my child get a scholarship? And how do student loans work? What does it cost for a college degree? And perhaps one of my favorites is right here in the center, which says, if I open a 529 plan, will my kid still qualify for financial aid? And this is, I hear this almost all the time. And the first thing that I ask people is, where did you hear this? Who told you that? And almost always it is a friend or a family member who's given this information. And, which is all good, but it's funny, 9 out of 10 times, that friend or family member does not even have a kid who is in, high school, let alone college. So the one thing I do want to tell you, there are a lot of myths out there regarding college saving and actually financial planning in general. So I would highly encourage you, when you hear things like this, versus just blindly believing it, please, verify the source, number one. And number two, if you have access to a subject matter expert, please meet with that person or have a consultation or what have you, versus just, blindly believing what's being told. So, and again, these things unfortunately spread by word of mouth. That's what I've seen. So now that we're looking at, and hopefully by the end of this presentation, most of these questions will be answered in this presentation. If not, feel free to reach out, and I'm sure we'll have a Q&A session, and you can always ask at that time too.
Sorry to interrupt here, Kanan, real quick. That's exactly what I wanted to say. So okay, folks, if you have questions for the speakers, please put them in the chat as they're speaking. And we will have like 5 minutes of Q&A with Kanan once she finishes her presentation in maybe another 25 minutes. And then we will do the same with Patrick. Then we will have a combined Q&A as well. So you have multiple opportunities and different ways to ask questions. You can also unmute at the end and ask questions. Okay, folks? So yeah, please go ahead, Kanan.
Sure. All right. So these are some of the questions, and like Mayank said, we'll have time for Q&A in the end. So when we talk about college, guys, the first and foremost is, what is it going to cost you, right? What are we planning for? And in addition to just your tuition and fees, which of course is bulk of the cost, I like to kind of break it down. There are a lot of incidental expenses that we have to account for, such as your room and boarding, right? Meal plans, utilities. A lot of schools, when the kids are juniors or seniors, they may be off campus in an apartment. So you want to account for some utilities, books and supplies, transportation. What if the child is out of state and flying in, flying out, and that's going to add up, right? So these are all your college costs, incidental costs, along with the tuition and fees that we need to account for. And I think equally important, there's something we call pre-college cost as well, which can quickly add up, such as application fees to different colleges, moving expenses, standardized testing, campus tours, right? So these are all pre-college costs that kind of, can come into play as well. But broadly speaking, when we think of college cost, I like to divide that. Are we talking about a state college or a private college? And then within a state college, are we talking in-state or out of state, right? So those are the three distinctions. Now, broadly speaking, I would say the average annual cost for a four-year degree in a good state, in-state college is about 30 grand. And we're looking at all the expenses and everything, 30 grand a year. And that's growing at 5-6% inflation. If it's an out-of-state, maybe more like $40,000-$45,000 a year. But then at the other extreme, we have a private school, which can be anywhere between $70,000 to $80,000 a year, growing at 5-6% inflation, which is crazy, right? So it really adds up pretty quickly. And I thought it might be helpful for us to, actually for me to share. Oops, this one right here. So this is my website. And you can do it now or feel free to, go later on. So it's just my full name. So kanansachdeva.com, pretty straightforward. And if you scroll down on the website.
Kanan, you might want to share the website right now.
Oh, it's not there?
There's in
Okay.
PPT. Yeah. So you need to do share and then.
Oh, yes, you're right. So, oh boy, I'll have to keep doing that on and off. Okay. Didn't realize that. Yep. Can you see it now?
Yes.
Okay, perfect. So this is the website, kanansachdeva.com. And you just scroll down to calculators. So here, the second one says, what is it going to take for college education, right? So I would encourage you to click there. And this is pretty interesting, very interactive. So let's say, we're looking at a college which is going to cost, I don't know, $40,000 a year. My child is 10 years old. So let's say we have 8 more years to plan for. He or she will be in school for 4 years. College cost is rising at 5-6%. So let's say I'm going to take maybe 5.5%. And there you go. So my goal, this is what I need to save for, right? So that's what the system says. So pretty interesting. So you can fill in whatever you want. And then down here, what if I already have a savings plan, right? So let's say I do have 10,000 set aside in some vehicle, and I plan to maybe save another $250 a month. And whatever savings plan I pick, let's say is giving me a 5% rate of return. And again, depending on whether that plan is taxable or not. So let's say it is, I don't get tax savings, so I'm at a 25% tax bracket. Let's add Massachusetts 5% state tax. Well, there you go. Well, my actual savings is $41,000. And if you click here, so this will kind of give you an idea. Well, so either you got to invest one time lump sum this amount, or increase your monthly contribution to $1,600 versus $250, or invest somewhere which is giving you almost 40% return versus the 5%, right? So it's pretty interactive. I would encourage you all to kind of play around with it. It's pretty neat. And again, that's that can be found on my website. Going back to my presentation. All right. So okay, so give me a second. So now that we know what the cost of college is going to look like, so now we need to sit down with parents and, before just throwing any idea at them, we need to understand, hey, what is important to the parents, right? So there are some factors that you want to consider before you start saving for college and before we know which plan is the ideal plan for you and your family. So number one is control. So a lot of parents will tell us that, whatever vehicle I pick, I want to make sure I am in full control of that savings tool. I don't want my kid to have any control over that money. I need to have control while the money is growing and, even when I'm taking the distributions. Same thing with beneficiary limitations. So what if my child does not go to college at all? Or what if he or she ends up getting 100% scholarship? What do I do? Am I stuck with the plan, or can I change the beneficiary as and when needed? So that's important to a lot of parents. Investment flexibility. What investment choices do I have in the plan, and can I change them? How frequently can I change them? Taxation and cost is huge, right? So taxation, guys, keep in mind whenever we talk about taxes, and taxes are confiscatory in this country, we all know that. So taxes, we have to talk at 3 different levels, right? So we talk at the source. So while I'm making the contribution, what is my tax treatment? While the money is growing, how am I getting taxed? And then when I take a distribution from that savings plan, what is the tax treatment then, right? So we got to account for that. And then, hey, what is it going to cost me to invest in this particular plan? So you want to know your internal cost as well. College financial aid, huge. So like the question that I had up there, right? Hey, is this plan going to count towards the calculation for financial aid? That is important. And finally, for my business owner clients, they want to know, what if they get sued tomorrow does this plan have creditor protection? That's important, right? So based on these factors, we can decide what savings vehicle or instrument is ideal for that particular family. Now, once we've done that, and I would love to share, this is a part of a plan that we prepared for a client. So I will be sharing that, just a part of that one. Give me a second. And, can you see that, Mayank?
Yes, I can, but Kanan, can you kindly make it full screen and if possible, like increase the zoom in something?
Okay, is this better?
Yeah, that's better, but there should be a full screen button for you, a presentation mode or something. So one thing is you see this on the right side, you can just click on that arrow, that will make the screen bigger itself in the middle of that PDF, right where your cursor was. No, no. Okay, that's
Yeah, actually, I don't see that on, yeah, you know
okay.
what?
No worries.
It's, wait, give me a second. Like, I don't know, 200, is this
Yeah,
big
yeah, I
enough?
think that's great. I think that's good
That's good?
enough. Yeah, yeah.
Okay, all right, cool. So, so like they say, right, picture is worth 1,000 words. So I thought this would be good to share. So broadly, the topmost row, so this is the most common ways to save for college expenses. And, and again, keep in mind, we're going to go into all of these one by one, but these are the three most common ones that we come across. On the left, the top left row is basically free money. The bottom left is cash flow, so basically matching your income to the expense, and we'll talk about that. And again, on the right-hand side, we have a combination of loans and parent retirement assets. So these are all combined, and that can actually pay for a college expense. Now, keep in mind, guys, every bucket that I'm going to talk about, it has its own rules, restrictions, limitations, features. It's virtually impossible for me to go over each and every one of those features in this short presentation, but I'm going to talk about at least the main features, and hopefully by the end of this, you'll have a great idea of what each bucket is all about. So the first and probably one of the most common ones is a dedicated education saving plan, which is given to us by the government in this country, by the IRS. And the most common ones in this category are a 529 plan, there's a prepaid tuition savings plan, and the covered L. Now, the covered L, let's start with that. What happens here is, so again, main features, the max amount that you can put towards a kid's account is only $2,000 a year. You can't go beyond that. Number two, you can only contribute till the child is 18. You can't put any money after that. It has to be taken out. The money needs to be distributed before the kid turns 30. And most important, and probably the biggest reason why a lot of people don't do it, it's not as famous, is because there are income limits. So if your combined household income is under a certain limit, you can't do the covered L. And most people, are husband, wife working, joint income, successful income families. So a lot of people will not qualify for the covered L. Now, 529, on the other hand, is a little bit more flexible, less restrictive, and compared to the covered L. And what happens here is your limitation for the contribution on an annual basis is $15,000 a year. And keep in mind that $15,000 is not per beneficiary, it is per donor. So meaning I, as the mom of my daughter, I can put in $15,000 a year into the 529. My husband, meaning the dad, can also put in $15,000 for my daughter into the 529 for her. My mom, meaning my daughter's grandmother, can also put in $15,000 a year. Her aunts, her uncle, everyone can put in $15,000 a year for one beneficiary, right? So again, higher limitations. It does not have the restriction of contributing only till 18 and taking out the money at 30. There is no such thing. And perhaps the most important, there is no income restrictions either. So whether you're making $100,000 a year or $1 million a year, it doesn't matter. We can all contribute into the 529 plan, and hence it's probably the more famous or the more common ones. And then if you, it's a new share. So I like this table a lot because this kind of breaks it down. So control of funds, it's owned by the parent, and all these three vehicles, Coverdell and 529 and the prepaid, the beneficiary can be changed anytime. There is investment flexibility, yes. However, in a 529, you're kind of restricted to what the state offers, and you can make changes max up to 2 times a year. Income tax is great in all three vehicles. You put in the money, it's after tax. The money grows, no taxes, you pull it out, it's all tax-free. So provided it's a qualified distribution, and they're all counted towards financial aid. However, each and every one of them is a parent-owned asset. And we'll talk about that in a second when I come to the grant section. So keep in mind, this is a parent-owned asset. And yes, they all offer creditor protection. Now, going back to my chart again, I don't know, there's a lot of back and forth. Okay, the second one is UGMA and UTMA. So that's another one which is available to all of us in this country by the government. Again, you can put it up to 15,000, same gifting rules will apply. By the way, 529, I don't know for any parents of kids with special needs children, just FYI. Recently, a lot of states have introduced a 529 ABLE account, which is specifically designed for special needs kids. And any qualified expense doesn't have to be necessarily tuition, could be their maintenance, support, health, all of that. Again, very specific, and there are some a lot of rules regarding that. It doesn't qualify for resource or earnings, or there is a Medicare payback, contribution limit, but that's a whole different topic. And again, we can always talk one-on-one who's interested in learning more about that as well. All right, so going to your UGMA and UTMA. So what happens here is, again, up to 15 grand you can put in, so it qualifies for the gift tax exclusion per year. And the thing is, so again, the reason why it's not as popular maybe is because what happens with this is the parent is just a custodian. So you're basically holding assets which actually belong to your child. And as per the state law, depending on whatever state you're in, upon the age of majority, which is usually 18 or 21, so as soon as the kid turns 18 or 21, the assets have to be transferred to him. He has 100% control over that account. And now it's up to him. It's his discretion, whether he or she uses it for the college or to buy a car or to go on vacation. You have no control over that, right? So, and probably that's one of the reasons where a lot of parents don't opt for that. And rightly so. I mean, I would not want to do that for my daughter. I'd rather stick with a plan where I have control. And then finally, savings and investments, right? So you could potentially say, I don't want to do any of these government-based plans or whatever. I am just happy with my own savings and investments, right? So I will put money in the bank, open a CD, or open a brokerage account, put some ETFs and mutual funds or stocks in it. Or I'm going to buy a real estate property and I'm going to put that on rent, and after 10 years I take my equity and I pay for my kids' college. Sure, that's doable, right? So it's after tax money, no tax benefits on all three ways. So at the source, at accumulation and distribution, you're paying taxes. You have control, no issue of beneficiary, and you can do whatever you want with that money, right? So that's another. And so these three will form the bulk of your education expenses. That's how most people will plan for that. Now on the left-hand side, so top left I said was free money, right? So gift. Anyone can give a gift to my daughter, and yes, she can use that for college. She doesn't have to pay them that money back, right? So that's a gift. Scholarship, which is merit-based usually, so a lot of schools will offer that. So again, free money and used towards your college. That's awesome. And then we have the grants, and that's what people want to hear about. So I'll spend a few minutes on this one. So grant, it's basically needs-based, right? And what happens is, as soon as we're filling out the applications, and as soon as the kid is about to go to college, we have to fill out something called a FAFSA form. And what that form is, really, it is a detailed analysis of all your assets and your income. And when I say assets and income, it's parents' assets, parents' income, student-owned assets, students' income. the family size, how many kids are going to college at a given point in time from that family. So so the institution is going to put together all these different factors, and they're going to come up with something called EFC. EFC stands for Expected Family Contribution. Now, based on that EFC, the college would decide whether you qualify for any grant or not. And please keep in mind, whatever you fill out in the FAFSA form is always from 2 years prior. So meaning if my daughter is going to college in 2021, whatever information I fill out in the form is from 2019 taxes. So you do have some time to kind of plan accordingly, because I'm sure everyone on this call would want to make sure that somehow we can reduce our EFC. And just so you understand, from next year onwards, EFC is going to be replaced by something called SAI, which is the Student Aid Index. So don't know too many details on it, but they're kind of slowly coming out, and the calculation and stuff might be a little different from what it is right now. But broadly speaking, it's the same thing. I mean, if I'll give you an example. So let us say I'm going to send my daughter to a college, which is going to cost me $70,000 a year. I fill out the FAFSA, I fill out the assets, liabilities, and whatever we have, not the liabilities, just the assets and the income, and all the other requirements that they have on the form, and I submit it. Based on the calculation, right? And keep in mind, when they do the calculation, guys, the parent-owned assets are considered different from student-owned assets. The parent income has a different percentage or weightage than the student's income. I'll get into that in a second, but let's say the number, the EFC number is $30,000. So the institution has determined that the such they have a family can afford $30,000 on their kid's college, but the cost of this college is $70,000. So the difference of $40,000, that is the grant. I'm going to qualify for that grant of 40 grand, right? And so again, so as I told, we all want to make sure that we can lower the EFC if possible. And some ways to do that would be to make sure that the parents own most of the assets, not really the children. So when I talked about these education saving plans or the savings and the real estate property that you own, they're all owned by the parents. And the weightage for that in the calculation is about 5.64%. So that is what goes into the calculation, right? Whereas if a child owns it, i.e. UGMA and UTMA, that number increases to 20%, right? So you don't want to, so again, one way to make sure EFC is lower is make sure the parent owns the assets, not the child. However, the assets are only 5.64%, not a big deal. But your income, and that is where it makes all the difference. The parents' income, guys, the weightage is 22 to 47%, right? And that is where we talk about, yes, successful family, husband, wife working, joint income. Yes, that the bulk of it will count towards that calculation. The child's income is 50%, but again, I wouldn't worry too much about it because, how much will a high school kid earn in a year compared to, of course, the parents, right? So again, asset ownership is important. Who's the income is equally important, probably even more important. And then some other strategies would be, if you're sitting on a lot of stocks or mutual funds, don't sell them right away, right? Because you want to time the capital gain distributions, because that's going to count as your income, and you will be charged at a higher percent, 22 to 47%. Same thing if you're taking any retirement distributions from your accounts, right? I would hold off on that if you don't need it, because that's your income. What if you have some discretionary incomes and as bonuses, defer them if possible. Don't take them, right? And finally, if you're a business owner, you're in luck because you can work with your CPA and you can take all kinds of deductions and you can kind of play around with the taxes and so those are some ways of lowering your EFC. But again, this is where the whole calculation goes into it, and probably Patrick will be talking more on this, I'm guessing. But excited to hear what he has in that front. And then when we talk about the lower row, so a lot of times, you could be the parent who might say, I don't want to do any of this stuff. I don't care for planning or saving or whatever. We're just going to think about it when my kid goes to college. I'll be earning an income, my wife's working, and we have great incomes, and we're just going to pay out of income and we'll call it a day. and you know, if my student is you could also qualify for work study, and that's kind of the same thing. So we call that technique matching your income with your expenses, right? So nothing wrong with that, guys. The only thing is, you know, I tell people life is unpredictable. So, I mean, who knows, right? What if one of you decides to stay at home after 10 years? What if your incomes go down? What if someone gets laid off? What if you get disabled? You know, what if there's a death? I mean, you know, so it can get tricky sometimes, but that's the risk that you would be taking if that's the strategy that you want to follow, right? So you may have to end up taking last minute loans, which may or may not be ideal for a family. And that kind of brings me to the right-hand side, which is loans right here, right? So that is a savings, that's a funding strategy, which is available to you, me, to everyone. Absolutely, we can go for student loans. Nothing wrong with that. And since we're talking student loans, I do want to share a quick, so I'll go back to my presentation because I do have a slide on that as well. Yeah, which is right here. So these are the kind of loans that you know, we can get in this country. So for an undergrad student, he or she could apply, or he could, again, it's an eligibility-based loan. You can get a subsidized loan in which the interest rate is very low. The government pays the interest. That's awesome. Or a grad student, or even an undergrad student, can get an unsubsidized loan in which the interest rate is a little bit higher, but you, the student, will have to pay the interest. You're responsible for paying the interest, not the government. Direct Plus loan is something that a grad student or even parents of an undergrad student can actually apply for. And of course, you're responsible for paying the loan. Great strategy. So for someone who has a lot of, let's say, eligible federal loans, you can actually consolidate all those loans. And that strategy works great because sometimes you can lower the interest rate with that strategy. You can get better repayment terms. And believe it or not, there could be some loan forgiveness too, right? So that's a good idea for, you know, if you have a lot of loans sitting around. And then last but not the least, private loans, right? I mean, you and I, you know, go to a bank or whatever and, you know, have, based on their terms, conditions, you can always, you know, go and get some private loans as well, right?
Quick question here, Kanan. Let's say the gap is $35,000. If I'm a US citizen, can I get the direct and direct subsidized and direct unsubsidized to add up to 35, or are there caps that the government imposes?
So wait, just repeat the question. You said your
So
gap
let's
is
say,
35.
yeah, gap's 35, right?
Yeah.
And using the direct subsidized and direct unsubsidized, can I go all the way to 35, or the government says, US government says, no, you are capped at only 25, beyond that, we're not going to give you any loans or anything like that?
It could happen because keep in mind, the government is involved here. So they have their own terms and conditions. So whatever the government, the federal loans, these are both federal loans. The difference is, one is you're paying the interest, the other one, the kid is not paying the interest, right? Here the government pays the interest, here the kid pays the interest. So yeah, you could, yeah. So again, you have to go by whatever the government says.
Got it. Okay.
You have more control because these are your personal loans, and but yeah, these are they are the ones who would say, what do you qualify for in this one.
Okay, thank you.
Right. And then if I go, so this is again, your loan sheet, and
sorry, there are actually a couple of questions on the chat, and they're kind of useful, so I'll ask them. One is, are these loans available for immigrants as well?
So I want to refrain from answering that question because that kind of takes into account your immigration status. Now, I don't see why they should not be available, but like I said, the federal ones are always dictated by the government. So those, I mean, whatever it is, I mean, they'll just offer you if they want to make an offer. So, and I'm sure in the application, in the FAFSA form, you have filled out whether you're a US citizen or not. However, the private ones, again, you're in control, right? So you can just go to any bank and they know your immigration status. And if they want to give you a loan, awesome. If not, then you know the answer, right?
Yeah.
But yeah.
Okay, great. And sorry, one more question. Again, immigration based, but this is for anybody and everybody. This could be true. What are the implications of early withdrawals? You showed us that sheet, that 529 and UTA and all that.
Mm-hmm,
What if, because let's say somebody has to go back to India
mm-hmm,
as a family and they
mm-hmm,
have to withdraw these funds early, what
mm-hmm.
are the penalties they're looking at, and any punishments and stuff like that?
So are we, what plan in specific are we talking about? Are we talking a 529 plan here, or are we talking
Maybe
about
if
your
you could just
savings?
give a general overview on all three, like are there severe penalties, or it's like 5-10% and you're good to go, or it's just capital gains? I don't know.
Sure. So if you're looking here, guys, like, and usually this is a big one again for 529 plans, early withdrawal.
So
So,
are you looking at the PDF now, or sorry, which one are you
oh
looking at?
yes, I am. Okay, I keep forgetting that I need to.
Sorry.
That's okay. Share and get back to my diagram right here, the
Perfect.
funnel chart, right? Can you
Yeah.
see it now?
Yes.
Okay, perfect. So if we're talking about specifically the 529, and so keep in mind, guys, again, these laws keep changing. So I don't know what you mean by early withdrawal, because there is a rule within the 529, which was passed, I think, in 2018, which says not almost, up to $10,000 a year, you can actually even take out to pay for K-2 through 12 tuition expenses, right? So it's not necessarily meant only for college. So up to even K through 12, you can take it out.
Right. I guess the question is more towards Kanan, this idea that let's say I accumulated $100,000 in 529, right?
Mhm.
And my child was about in 1 year from now going to go to college, but now we have to go back to India, right? So now we can't leave the money. We are going back permanently. Can we withdraw all this money? That $100,000, if we withdraw, what happens?
Okay, got it.
In 529 versus UTMA, UGMA, I mean, savings, it doesn't count anyways. Yeah.
Yeah, so okay, perfect, thanks. So yeah, so 100% you can take it out, yes. So that's where it's flexible. Even if you don't use it for college, you move back to India. The only thing is you're gonna lose that tax treatment, the tax preferential treatment, meaning on the gains, so if you had put in 10,000, that grew to $100,000, and now you move to India without using it to pay for college in the US, on the $90,000 of gain, number one, you have to pay taxes. And number two, you'll pay a 10% penalty on the $90,000 gains, right? And again, very similar to, because I'm sure that family who's moving to India would also have probably done an IRA or 401k or something for their retirement. So pretty much the same deal, right? You take out your 401k and you move to India, you're less than 59 and a half years old, you will pay taxes on the entire amount of 401k / IRA, and you'll have to pay a 10% penalty. So no different, right?
Okay.
From the retirement assets either, but at least you have the flexibility. You still at least were able to grow your money by 90 grand. And yes, you pay a little bit of taxes, which is the exact same thing as you would do in savings and investments anyways,
Okay. And
right?
UTMA and UGMA, any early withdrawal things?
So this is more of a kid's thing anyway. So not really. I mean, not that I'm aware of, to be honest, because it is in the child's name and the child has been paying taxes all along at the kiddie tax rule. And I think I probably might have skipped. Yeah, I think because when I showed you the table, right, for the 529s and stuff. So here is the one on Atma and Atma 2. Right here, right? So look at the last column. So yeah, parents, well, they only have control till the kid turns 18 or 21, and it's the kid's assets anyways. You can't change your beneficiary. You can't put the money in any assets, a lot of investment flexibility, but here you go, it's taxable to the kid, right? So, and that's where you want to work with your CPA, because the kiddie tax rules will apply at that point in time. So it's like a regular brokerage account, if you will, which is after tax, is being taxed while it's growing, and yeah, you take it out, it's getting taxed as well.
Perfect. Thank you so. Yeah.
And
go
yes,
ahead.
it is counted as a child's asset, which is not good. That's 20% weightage versus the 5.6% in your 529s and stuff. So yeah, that's on the UGMA side.
Gotcha. All right. Thanks, Kanan.
Sure. Okay. So just kind of wrapping up on the right hand side, right? We have a couple of more buckets to look at. And let me go back to that chart again. Perfect. So loans, right? We just covered that. Permanent life insurance, known as whole life insurance. So again, a great vehicle for a lot of parents to put aside money on. It's an after-tax basis when you contribute, but the good thing is you're building cash value. Going tax deferred, you can take it out in a tax efficient manner. So a lot of people are doing it to supplement their retirement savings in a very tax efficient manner. The good news is this is it's a personal asset. It is not one of those government, IRS, or whatever related assets. So there are not a lot of rules and restrictions. However, you can pull the money out from here. There are ways of doing that. And the good thing is the whole life does not count in that whole EFC calculation. So it is not even considered as a parent asset. And that's one of the reasons why people like it. But then again, depending on how you take out the money, you want to perhaps put it back in also because it's going to otherwise impact your retirement for which you started this plan anyways. The other good thing is if the parent gets disabled in between or he dies, God forbid, he or she passes away, the insurance could be used to take care of expenses as well. So again, there are some benefits to that also. Last but not the least, we talk about parents' retirement assets. So that's another idea. You could say, you know what, I have this IRA or I'll take a 401k loan, I have a Roth IRA, I'm going to use that to pay for my kids' college. Yes, you can do that. Is that a great idea? I don't know, because you will be tapping into your retirement savings. So that is going to impact your retirement. Keep that in mind. But no one can stop you from taking it. It's your money. But few things to be mindful of. When you take out the money from these accounts, yes, the 10% penalty is waived because it's one of those exceptions. When you take out the funds for your kids' college, you don't pay a 10% penalty. However, guys, please don't forget, if it's a regular traditional IRA, you have to pay tax on that entire amount of money. If it's a Roth IRA and if it's been held for 5 years, you are not going to pay tax on your contributions, any Roth conversions, but you will be paying taxes on any earnings, right? So just the 10% penalty is waived, but yeah, you are going to be paying taxes on the earnings. And again, anytime you take out money from these retirement assets, not the permanent life insurance, but this bucket, guess what? It's going to be an income, and that income is going to be counted in that EFC calculation. Right? So you have to really plan for all these things. So at the end of the day, guys, what I tell people, and this is what I've seen in my personal situation, in all my client situation, it is not just one particular bucket that I'm going to use to pay for college. Absolutely not. It's always a combination, right? So I may have a 529 plan. My daughter got some scholarship. And hey, you know what? For the rest, we just kept paying out of our income. So we're doing a combination strategy. Or I have this real estate property that I'm going to sell, but I'm still short. So you know what? I'm going to apply for a loan, right? And maybe also, my student got some work study or whatever. So again, it's a combination of all these different buckets, and that's how you arrive at paying for that college expense, right? So that's where I say that it's not a one size fit all. Absolutely not. We have to consider a lot of factors before we decide what's the right strategy for a family. And lastly, when we're talking about all of this, I just want to share one last slide with you. I think it'll be helpful because I don't know if you know this or not, but when you have kids going to college, when you file your taxes, guys, and again, this is more of a CPA thing, so I will encourage all of you to work with your CPA. You and I can be eligible for some tax credits and deductions right here, right? So we have the American Opportunity Tax Credit, Lifetime Learning Credit. The first one is per student. This is per family, per tax return. And if you've taken any student loans, up to $2,500 can be deducted as an above the line deduction when you file your taxes. However, keep in mind, all of these are based on your modified adjusted, gross income. Right? So a lot of times, again, the same situation, successful husband, wife working joint income, a lot of times their MAGI might be much higher that you might not get any of these, but it's good to know. And that's where I said I will encourage you to talk to your CPA and get their advice on that as well. Perfect. So that you're not missing any of these important credits and deductions in your taxes.
Very nice.
And now it's time for questions.
Awesome. So I think, yeah, I think what has happened, Kanan, is people were just, putting in questions in the chat and I've been asking, and there was one or two more, but let's hold off on the questions in the interests of time.
Sure.
And let's move to Patrick and then we'll come back to the remaining questions, okay?
Sounds good. All right, so I'll
All right.
stop sharing my screen.
Thank you, Kanan. And
Sure.
Patrick, yes, you have the floor now.
Great, thank you. Thanks for everybody. And what a great presentation that was also. Now let's see if I can pull my slides up, which is always challenging for me. And we'll go from there. There we go.
Okay, I can see it.
There we go. So when we talk about education planning, and I'm part of College Funding Solutions, and that organization has been around since 1993. I've known those guys since 1993, and I joined them last year when I decided to really specialize my practice. I started going more towards not wholesaling anymore. I used to call on people like Kanan, but now I'm starting to work with students because I know I'm going to work for another 10 years. I wanted to do something that I thought was going to be interesting for the next 10 years of my life. So I affiliated with College Funding Solutions, and I affiliated with also the American College Foundation, which offers a scholarship on an annual basis for all students, freshmen through 12th grade, and they can apply for it every year. And it's really a merit base. It's an essay, a 500-word essay that anyone can win. Even if you're a billionaire, you can actually still win it. So one of the things we want to talk about as we start the college planning process is college is three things. And when we talk about college, it's really essential. I mean, it's really even difficult to get a position today as a receptionist unless you have a college degree. You kind of scratch your head sometimes why they're requesting that. But I think what they want is they're looking for a commitment around what you're going to actually do as the student. And one of the things that's very important is, I don't know how many students are on this today, but hopefully there's a few, because it's really the students that are going to be driving most of this as far as whether they're able to get money at a discount from a university or college. We're going to talk more about that as we go along, because we know college is very expensive. We just went through all the calculators, how much it's going to cost us. One of the things we look at is, how am I really going to actually save that money? And one of the philosophies that we have is that college is one of the most expensive endeavors you're going to take. Really, retirement is your most expensive, your house, retirement, and then college funding. And college funding has a tremendous impact on your retirement also, depending on what you're making. And the one thing we want to stress, though, is that when you look at college and university, it's not like when we went to college and to the university. It's very different today, because college is a business and they have very big egos. And they have a big ego because they talk about their endowments, and that's their ego. So they're a business, and they're a great business if we were in it ourselves, because they know every dime you have that you could put towards, or they could assume that you could put towards your child or student's education. And then they're going to decide what type of discount they're going to give you based on that. So it's a great business. I mean, I wish every car dealership would like to know how much money you have, and they're going to decide as you're going out to do a negotiation with that for that car, how much you can discount it down, and they know whether they have to or not. That's the same with college. And I think that's what people need to understand is college is a business, and you're in a disadvantage because they hold all the cards. So, and the odds are really stacked against you. And I think I've always been shocked by this. 50% of college students entering college this fall, 50% of them are going to drop out. Some of it's lack of funding. They've run out of money. They were capped. They didn't want to take on more loans. They picked the wrong school for what they wanted to do. They thought they wanted to go to, University of Alabama, and it really didn't have the degree that they were looking for. And they ended up changing schools, which puts them behind, or they've picked a major. And I can speak to this with my own children. I had a son who went to the University of Washington, thought he was going to be an engineer, showed up in a couple of math classes and didn't compete very well against the foreign students who were much more dedicated. And he changed his majors, and he added time for him to graduate, which is today the average is 5.5 years to get your bachelor degree. And so when you talk about this, the one thing I want to stress is a lot of people try to go it alone in this process. You don't go it alone for your retirement. Most people don't. They rely on information. And as Kenan said earlier, the last person you want to take information from is, your uncle who was thinking about how you should be doing this, or your neighbor across the street, because they don't really know. Because one of the things that you have to look at is when we know that the college has all of your information, you don't have the college's information. Because one of the things we want to look at is we want to make sure that you're going to graduate not at a 5.5 year mark, and we're going to make sure that you get the biggest discount you can get. And that depends on how your money is held and in some of those vehicles. And that's one of the things that we look at. One of the other issues that we really look at is you got to be a good student to get a discount. And that's not on parents, that's on your children, that's on your students. And if you're starting your senior year or really your junior year, you're very behind the 8 ball, not only from an accumulation of asset situation, but also where am I going to go to school and how much money am I going to get? And have I taken the right classes? Have I done the right summer jobs? Did I do the right internship? So getting straight A's is not enough today. And I know that you guys in January had an overall one of these issues. And one of the things we talked about was you want to make sure that you're not just relying on academics. And let me stress this for you, how important this is. I was in a conversation with a gentleman who he was very proud of his daughter. She's a 4.0 student, and this year was her first year at University of Massachusetts Amherst. He goes, we did a great job. We got $2,000 for her, and we're going to make up the difference. So I was looking at it, I'm like, well, what did she do that you only got $2,000? He goes, well, what do you mean she got perfect grades? I go, well, what did she do socially? What was she in? What bands was she? Was she in a band? Was she in a club? What did she do socially to promote herself from that standpoint? So you can't just be a straight A student. And in contrast, I'll just use my daughter. My daughter received from University of Massachusetts Amherst $26,000. He and I are in the same economic realm. We're both over 6 figures in our incomes. The difference is my daughter, since her freshman year, has been doing like toys, for tots. She's been doing different jobs. She works for the Council of Aging. She knows exactly what she wants to go into, and she's patterned her whole behavior this last 4 years so that she now has this social calendar that looks where the college is going to say, okay, we know you got great grades, but we know you're also social and you worked, because they're making an investment in the student, not us. They're making the investment in the student. So that's where it's really important to be well-rounded, or be an amazing athlete or the best tuba player on the face of the earth, and not have necessarily the best grades, but they want you because of that. And then we look at the financial situation. How do we close that gap? Because my daughter really didn't want to go to the University of Massachusetts at Amherst. She wanted to go to the University of Alabama. University of Alabama is $53,000. She had a $22,000 gap. Dad here is not writing a check for $22,000 when I'm looking at UMass Amherst for a $4,000 check. So she did a little thing, and we talked a little bit about this, that most people don't do. She'd been working with her advisor at University of Alabama all year, because that's where she knew she wanted to go. So she prepped herself completely for that. But what she did is she appealed her letter that they gave her for financial aid. And only 10% of students actually do it. And the students need to do it, not the parents, because the college wants to see who they're investing in. And she appealed this and tried to close that gap. And finally, what happened, which is kind of interesting, is they decided they really wanted her, because she's in that top tier student. She's a straight A student. She's very socially rounded. She's worked. They know that she's going to be successful. So they closed the gap on her financial aid, and they matched the UMass Amherst offer. So it's going to cost her $4,000 to go to the University of Alabama. But she did things other than just get great grades. And that's one of the things we help people with, is looking at your overall situation so that you're a great student that they want to invest in. Because this is a job interview for your student for that college. And we talk about this, and we've already gone through this today. There's the two types of funding: is the gift aid and the self-help aid. The one thing I want to clarify, though, if you're not a U.S. citizen, it's very difficult to get federal aid. Even if you're a DECA, the DACA dreamer, they're ineligible for federal aid. But don't let that deter you, because the states will give you aid. But more importantly, when we look at all of where the money comes from college, it's really 97% of the money comes from the actual college. They're the ones who are doing the investing with their big egos, which is that endowment fund. They're determining how much money they're going to close on that gap. They looked at all your resources, and now what they're going to do is they're going to say, how motivated are you to send your student? If you're in that top tier, because I don't know if anybody's ever been involved in the academic process, but when they're going through and who they're picking for students, they're looking at the students that they absolutely love. And the one thing that people forget about is the letter of recommendation is almost more important, if not more important, than the SAT exams. They're looking to see what kind of person you are so that you'll invest back in that school when you're an adult. And that's one of the things that people forget about is if I just have great grades, I do all these things, I mean, the doors are gonna open for me. They're gonna open for you. You're just not gonna get much of a discount if you put away a lot of money. So that's one of the things that we really wanna talk about is where your assets are. How do we position them so that we give you the biggest discount? But if you're not a 3.5 or better, or three or better and have something interesting to add to yourself, that's really the opener to have them open up their coffers. If you're a 2.5, you better be an amazing athlete or the best tuba player on the face of the earth, because you're just filling seats. You're in that third category and you're just filling seats and you're paying full boats. And so you're going to walk out of school probably with a fairly large loan situation. And I think when you're picking these colleges though too, the one thing you have to ask yourself, and when you go back and you go, why is 50% of people only graduating? Well, a lot of people don't understand when they're applying to colleges what the advantage is, and we happen to have this information. Most people don't. You can ask a college planner if he knows what the yield is for the school that you're going to apply for. If they don't know that, that tells you right now that you're behind the 8 ball, because the yield that the college has as far as what their students to fill their seats tells you how willing they are to offer money. So let's take UCLA. I'm a West Coast person. I went to a West Coast school. So if we think about that, UCLA has 25,000 seats they want to fill. They're going to send out 50,000 admissions. And they know they're going to fill that. They take 25,000. They're not overly concerned whether they have to give out a lot of money or not, because they've sent out enough. So their yield's very high. So we know, unless we put money away like we talked about earlier, we're going to be borrowing a lot of money because this college is not going to be giving us that money, or we need to bring something really different and unique to the table. And as much as everybody thinks it's athletics, it's really not. It's academics. That's really what they look at. That's where the money is for when you look at sports. It's very narrow, the amount of money, and it's a very small group of people that get money from a university. You think because you see it so much, that's where the scholarships are. It's really not. It's for academics. It's for being smart, because they know that if you're smart, you're going to put more money back in their coffers because you're grateful for what they gave you during that time period. And the one thing we talk about with the FAFSA, and that's coming up, and she did a great job explaining that, but one of the things we look at is accuracy is essential. We know that 75% of all FAFSAs have errors on them. Some are big, some are small. And we know that October 1st is the day that you can actually submit your FAFSA. If you're not putting that FAFSA in on October 1st, you're behind. You're now standing in line and there's a whole bunch of people in front of you. And so one of the things you want to make sure is, and I can't stress this enough, it's very difficult to do this on your own. You need to work with a team. You need to have a good financial person that knows what they're doing around the FAFSA. They know how to position you so that you're going to get the biggest discount. But you also need to work with a person that's going to make sure that your student is ready, They've written great essays. They've gotten good letters of recommendations. They know what they're going to be doing when they go to college, because that will cut down on where you're at. Our college funding solutions, people in our program, we like to start them as freshmen and sophomore, because we know if you're a junior and senior, you're already behind. And as an 8th grader coming in your freshman year, we think you need to start the process of what you're going to be doing as far as where you want to go for college and what you think you want to be. And let's be honest. I thought I was going to be a journalist. I wrote for newspapers in high school, but I'm not. I'm in the financial services. So, but those are things that help me though, because I now can ask questions. I know how to ask questions. I can tell when somebody's giving me a good answer if I need to clarify a little bit more. So these are the things we look at as far as strategies of making sure that you get to the table and you get the most money possible. And the one thing again is I keep coming back to, and some of you have right now your offers for your senior for next year. Look at that and make sure you go out and ask for more money. And if you have questions about that, you're more than welcome to give me a call. That was one of the things I said I'd gladly look at. And the other thing you want to know is how does your offer compare to someone that's similar to your situation? You know, you may be making more money than them and than someone that's less, but your students in that top tier, so they're going to give you a bigger discount. So you need to really understand where you're at in that peer group. You're going to ask a question?
Yes, Patrick. So thank you. So real quick, you said we should, start early in the 9th or 10th grade, freshman, sophomore for the planning. What about the financial planning? Since we report scores, FAFSA scores are 2 years earlier, right? So would working in the 9th and 10th grade start work in that time frame? Would that still work for financial aid, or we should start a little bit earlier?
You should start a little bit earlier. If you're deciding that you're going to fund your college education, say you're making $300,000 a year, you don't think you're getting any financial aid, and you're probably not going to get some unless your student's really in that top category. And then they want to go to Princeton. Princeton wants them. You're going, I'm not writing that check. Princeton's going to write that check because they want you, because that's their deal. They want the best of the best, and they'll write that check even if you're not going to get that student in. But you need to start early. And the one thing you have to be very cognizant of is you need to make sure you take care of yourself first and fund your retirement, because you can always use your retirement to help you with this education process. But instead of starting to shell money away, I just had a person in here who's a good friend of mine who's a wholesaler, a financial wholesaler who's always made $300,000 or $400,000 a year. Well, the last 3 years, he hasn't been. His income's dropped off significantly. He has $900,000 in 529s. So he's like, oh, I wouldn't mind have had some of that money in my retirement plan. And he's probably going to see very little financial aid, except he does have an advantage. His one son's a nationally ranked track star, and he'll get money to go to school. He's already been getting offers. So, and the other advantage he has 3 kids going to college all at the same time. But he wasn't necessarily smart in funding himself first and then funding the excess for college. And that's what we would tell you to do so that we can get you the most or the biggest discount. But again, it starts with the student. They need to make sure that we can actually show that they need a discount, that the university thinks they're in that top category. We love that student, or we like that student. And you're not just filling a seat.
Gotcha. Makes sense. Thank you.
And I think the keys to your success out there is you really need to understand the process completely. Even though I think you should be working with someone, you should be working with a college coach, you should be working with your financial advisor. They typically work together. I do both. And I also provide it from A to Z. But I work with a lot of financial advisors because we're on the college planning side, and they have a great relationship with that person. But we have software that runs ahead of time if we make changes to your portfolio of what it will do to your score to allow you to know if you're going to get more money or less money. And we provide that information to your financial advisor. But starting early is the real key. I mean, my kids they've known since they're little kids where they want to go to college. My son's always wanted to go to Holy Cross. My daughter's always wanted to go to, University of Alabama. My freshman this year, he knows he wants to follow his brother. He wants to go to Holy Cross. And my youngest, she wants to go to Vanderbilt because that's where her uncle teaches, he runs a medical lab. She wants to go to Vanderbilt. She's been there a bunch. She loves it. So she needs to be pretty special to afford those bills, because Vanderbilt's one of those schools that doesn't give out a lot of money. So that's really what we're talking about. And the key is also making sure you get out of college as quickly as possible. My son has a friend who's at UMass Amherst in the business school, and he graduated in 3 years. He went year round and graduated as quickly as he could because it cut down on his costs, and he's able to start earning money in that 4th year and that 5th year. Instead of paying out money, he's now earning money. And that's what we really want to focus on, is how we get you in and get you out as quickly as possible. And that's really around making sure you know what you want to do. And then looking at your college enrollment options. I mean, everybody loves their favorite school. And when we talk about what school do you want to go to, we know we have the software that tells us what the yields are for every school. We know what their averages are for giving out. We know all of their financial information that they're giving out. And here's what most people don't know. The colleges know what the other colleges are giving out. So they may be closing that gap, but they're going to only close it so far because they know what everybody else is giving. And so one of the things that we talk about is very, very few times you want to do early option, because it takes away your options of bargaining between schools. In my case with my daughter, it was UMass Amherst and University of Alabama, and she played it very well. But we tell people all the time, you're going to negotiate with this school to get the biggest discount you can. Just like when you buy a car, who walks in and says, I want to buy that car for that price on that sticker? You know, everybody wants to bargain for that situation. It's the same for college, because college is a business. And they know. Go ahead.
Patrick, I'll jump in with one more question here.
Sure.
Early decision versus normal admissions. When I did a little bit of research in my first, presentation, I saw that it's like 10% selection rate for early decision. Even when if you include athletes, it goes up to 14%. But let's say we remove the special cases and all that, we're still looking at 8-9% versus a normal decision is like 4.5% selection rate, right?
Right.
I mean, gets halved, right? So in a sense, you are buying a seat to a certain extent by going early decision.
No, you are buying a seat.
You are not, or you are?
You are buying a seat. If you go early decision, you're absolutely buying a seat, because they're going to give you less financial aid, because they know they've got you, and they know how much money you have. Remember that. They know how much money you have. So you're absolutely buying a seat. And if you have the ability to do that, go ahead. We would tell you, if you're that top tier student, have confidence in yourself that they're going to want you as much as you want them. And if they don't, do you really want to spend the next 4 years there? You have to think about that, not just, I really want to wear that Syracuse orange sweatshirt. I want to make sure they want me to wear it, and they want to give it to me, even though I'm going to write them a check for X amount of dollars. And so that's why we say, generally speaking, you're not going to do early option. We want to be able to we want to make sure that we can give you the biggest discount off that sticker price as possible.
Gotcha. Thank you.
But yeah, it's a very low percentage, no matter what you look at. 10, 14, and the athletes come in because they're signing a letter of intent. I did when I was, and that's how I went to school to start. That's what I did. I knew I was going. And so that's a different situation. But as you look and you saw, it's very small. I keep trying to emphasize to people, don't rely on athletics, rely on academics. And if you're a good athlete with great academics, it raises the posture, because you're raising the score for that team for the NCAA, and they track all that stuff.
Got it. Thank you.
And so, and you talked about this earlier in January when you did your presentation, is making yourself an attractive student. It's not just about grades. And I can't emphasize this enough. And you want to make sure that you're really not caught in culture. It's not really, you just want to make sure that if you're in a culture, you don't want to be perceived as you're going to be an engineer, because you may decide that you want to be a great writer. And so you want to make yourself very attractive. I have a lot of Asian students from China that people go, well, they're going to be engineers, they're going to be mathematicians. On the other hand, they want to be actors and actresses, and they don't want to be pigeonholed into that scenario. So you want to be very careful. You want to be very well-rounded, so you get caught with that culture and that you can pivot and make changes for what's important to you. And as we talked about with the planning for college and paying for college, it's really individual. Every child is different of how you're going to, what school they're going to go to, how you're going to pay for it, what they're going to get from that standpoint. I see kids that you think are going to get no money because their parents make a couple $100,000 and they get a lot of money. My son's at Holy Cross. It's a $75,000 a year gig. He pays $15,000 because they wanted him because he's academically, and he's the first kid in the world to wear the bionic pancreas because he's a type 1 diabetic. And there's a BBC special about it. So they really wanted that kid at their school. So they cut it down until he accepted that offer. So I can't make this and stress this enough. You got to make sure your options are open. You're an attractive student. And I go back to, you can have all the money in the world, but you got to have great letters. Letters are everything. It will really also help you get money. That's the key. It will help you get a discount, because if they see that you've got quality that's following you, that looks at you, and they're inspired by you, they look at you and they go, you know what, this person's going to do a good job, and they're going to maybe be good enough someday that they'll have a name on their building. They gave us enough money. So that's how colleges look at things. And we know that college is a business, and we have to be careful with that. College is a business, because we know with the loan situation in 2007, New York prosecuted a lot of loan and colleges for collusion. So we have to be very careful to make sure that we're making informed decisions. And that's where it's really important to work with someone that has that information. You work with your team just like you would with your retirement, just like you do with you're buying your home. Most of us don't buy our home on our own. We have an attorney. We have to make sure that we're able to not lose our house because the title's not correct. We have a realtor that helped us find it and walk it through it. It's the same with college. You need support. It's very difficult to go it on your own. And most people, think they can do it on their own because they did it on their own. The world has changed significantly. College is big business now. And they know they are. If you look at the inflation rates on tuition, it's significant, and it doesn't compete on the same level as other things, because colleges know that everybody's trying to get into those top tier colleges today. And one of the interesting things is, if you see my background, that's one of the finest colleges in the country. My oldest son went there. It was $18,000 a year. It's a Pac-10 school. It was a rival for me, University of Washington. And it's one of the prettiest campuses of any colleges I've ever been to. But he got very little money. But at $18,000, between him working and my wife and myself, we're able to handle that on an ongoing basis. So that's what you have to look at. $73,000, that's pretty tough to write a check just out of current earnings, unless you're making a lot of money. So starting early is really important, especially being an attractive student. You need to start just as early, depending on where you want to go to school and what you want to be, so that just like you're saving for money, you also want to make sure that you're a good candidate that they want to invest in. And I can't, the comprehensive resources that are out there today are amazing. You've got professional assistance with financial aid applications. We do that. Lots of people do that. Award letter evaluations and appeals. We do that. Lots of other people do that. Private sector scholarship assistance. We do that. Lots of people do that. But scholarships only account for 3% of college funding. So we think you can do it smarter with getting significant discounts by being a student that people want. And everybody, including myself, we all give hands-on guidance and support. People charge a fee. We charge a fee. The one thing you want to make sure of, though, there's a great story around this. A person that I know very well, her daughter just graduated this year from Case Western, which is the MIT of the Midwest. She's a nursing student. She went there. Her mother's been a single mother since her daughter was 7 years old, making less than $50,000 a year. They screwed up on the FAFSA. And so instead of that student going for free, which she should have done, because not only did she have great grades, she was a great option for that school. She graduated top of the class, not just top of the nursing program. She graduated top of the class for Case Western, and she has $120,000 worth of student loans. So she's a nurse. She's going to be able to pay that off over time. But that's a 10-year involvement for her. And she's working at Cleveland Clinic, and they give her some money for coming to work there to help pay that off. But if she wasn't, she would have walked away with no student loans at all. She would have gone to school for free. She's that student that everybody wants. They just did the FAFSA incorrectly. They had paid $4,000 for a college coach, but that coach was only there to help her academically. They really didn't even need that person. They needed someone like Canon or myself to really help them make that FAFSA really work the way it's supposed to. And so we've had over two decades of experience, College Funding Solutions. We've been in this business for a really long time. I've been doing this business for 40 years. I've been on both sides of the equation. I've supported people that say they're in college planning. Some of them are, some of them are not. I always ask, how are you helping the student get through college? How are you helping the parents make sure they get to the other end so they have some money left so that they can retire themselves? And so that's really what we're looking at. And we're resources today. There's lots of resources out there. If you didn't like us, if you loved us, that's great. But find someone that does this to help you, because you really can't do it on your own, because the colleges have you at a huge disadvantage.
Great.
And there I am. So you can go to my websites. They're right there. You can look and see what we can do for you. And if you want to look at my background, you can go to my LinkedIn. I've been in this business for quite a while. I've actually worked with the richest people in the world when I worked for Fidelity Investments. They weren't concerned about college funding. I'll share that with you. But one of the things we talk about, though, is the experience that we bring to the table. I've not only helped people get their kids through college, I've done it myself. So I've gone through this process. My oldest is 28. I've got an 18-year-old and I've got a 14-year-old who's a freshman. I've seen all of this change over that short period of time to get through the college program itself, of how to get in there and how to get a big discount. Anything else? That's quick for me.
Nice. Well, thank you very much, Patrick. If I were to summarize what you said, I feel it was build value as a student so that you are attractive, and then go and get some really good financial advice so that you can negotiate the best deal possible. And Kanan here, if I were to summarize, basically mentioned what are all the options available under the sun, how you can mix and match them. So you guys complement each other really well. And that was a very fascinating discussion. So thank you very much. Now what I'm going to do at this stage is there were a couple of questions in the chat, and I will open them up. And whosoever wants to take it, or maybe both of you want to answer it the way you want. So the first question, home equity. How colleges calculate home equity? If I have $200,000 in cash, $500,000 in mortgage loan, should I pay mortgage or should I keep it in cash in the view of FA? So,
Do you want to take that?
Sorry, what was that?
Who do you want to take that, Canon, or do you want me to?
You can go ahead, and I'll want to it. Sure.
Yeah, and I got to figure out how to stop sharing so you can actually see me, or I can see you guys. So one of the things you want to look at is your home is not part of that equation. They do look at, though, if you've got a lot of equity in your home, is it a resource that they add? Typically, no, depending on where you're at. But that would be one of the things where you'd really, instead of just making an off-the-cuff comment today here, you'd really want to run some numbers and see what makes sense for you to do. And that's why I go back to, you need a professional. Either one of us can run that for you to see whether it makes sense or not for you to pay down the mortgage, or put the money someplace else that you can be more effective with it and keep your FA score low.
And then, yes, I would add on to that. So he's right. Patrick is right. The equity of the house that you live in normally does not get counted in the FAFSA, because obviously the college understands that the parents need a roof to live in. So, you're not going to sell your home to send your kid to college. And then as far as, paying the mortgage or, investing somewhere else, again, that's, you want to look at your cost of capital. That has a lot to do with it. So depending on, we'll run the numbers, but given how the interest rates are today at this point, I don't believe there is, any other vehicle out there. And again, I'm not talking the cash in the bank. I mean, that's like highly inefficient money, low yield, high taxes. But other than that, I don't think there's any other vehicle out there which would not be able to give you more than what you are paying in your mortgage today, because the interest rates are so low. But again, it's a one-on-one thing, and we'll do the calculation and advise our clients.
Don't run off and say we both told you that, you should just pay your mortgage off.
Yeah, I think the important lesson here is it's individualized. You can give generic advice or generic pointers, but every case is different. And that's why, financial planners or other people need to look at it. I guess that's what you're saying, right?
Correct.
Okay, another one. What are the advantages of federal student loans over private loans? I guess, and disadvantages. We should ask both.
So I can take that. And real quick, I'm not a loan expert, to be honest, by any means. But the federal student versus private, so again, if you remember the slide that I shared, depending on if you get a subsidized versus unsubsidized, so one factor is, the government would actually pay the interest. The student might not be required to pay an interest, versus if it's a private loan, then you are paying the interest. You're responsible for that. And secondly, even if it is an unsubsidized where the student has to pay the interest, usually again, it's not all the time, but usually it would be a better a rate compared to what you might be able to get in a bank or, on a private loan. But again, we have to take into account the low interest rates and all of that too, given the environment that we're in. But that's what I would say very broadly speaking. Patrick, do you want to add to that?
The only thing I would say is anytime you can get a government loan versus a private loan, unless it's your grandmother, it's a better loan for your situation. And when they talk about eliminating college debt, they're really talking about federal loans too. The $50,000, the federal loans are what they're going to really look at first. I know our senator from Massachusetts here is always talking about we need to eliminate debt, and the number keeps coming back as $50,000. And they're going to look at the government loans first on that versus the private sector, because somebody's going to have to pay the private sector back if they're going to just cancel those loans. The government loans, it just goes into the budget.
Yeah, and with COVID too, I mean, last year there were a lot of loan forgiveness or interest rates. People didn't have to pay that at all, like zero interest loans, and all of that happened too because of COVID recently.
Nice. So I guess we have 5 minutes remaining. So if anybody in the audience has questions, they can unmute and ask them right now. I believe Ramendra ji has something to add or ask a question. Ramendra ji?
If you guys have any other questions, feel free to actually ask. We have a few more minutes for this session, so we can just actually open it up to all of you. If you have questions, feel free to ask here. Otherwise, I hope you find this information useful. Thanks everyone for joining this call. At least I found it really useful. Thanks to our panelists, both Kanan and Patrick as well, for providing such an insightful information. I'm pretty sure that there's a lot of information here that all of us can actually take and start planning for our kids. So thank you so much. We just have a couple of other things, but if you have any questions, any other questions anyone would like to actually ask before we can wrap up this?
Can I take 1 minute of everyone's time?
Sure.
One and a half minute maybe? Okay.
Sure.
I do want to point out something, and I think this will be very, very interesting if you guys want to do that. So give me a quick second. I want to share something right now. Okay, this is it, right? All right, so if you go on my website that I just pointed out earlier, kanansachdeva.com. So right here, guys, this is pretty cool. So it's called Financial Literacy for Children. And I would highly encourage you guys to click on that. And so here it kind of divides into different categories. So, I think it's important to kind of give some of these lessons to our children, our teenagers, even our graduate students, early on in life, pointers for parents as well. So if you look at, something for teens, if again, there are different, categories here, like saving, for example. And in fact, my 12-year-old nephew asked me 2-3 weeks ago, what is the power of 72? What does that mean? And it's right here. It's the amount of time that it takes to really double your money. And again, these are like, for kids to play around with. It talks about, what is cash versus check or credit. Teenagers, a lot of teenagers will, they have jobs and stuff, and, they have no idea even how to decipher their paycheck. They don't even know how to decode your paycheck. What does it mean, right? And same thing for, again, cash or check, and, owing the money or saving. And finally, for grad students, kids who are in college or, just graduated, this is pretty interesting too, because they learn how to, the budgeting basics and investing and, income. So I think it's a pretty interactive tool, and it's very interesting. And I would encourage you guys to spend some time on it with your kids if you get a chance. So I just thought I'd share that with you.
Very nice. I think that's a pretty useful resource right there.
Oh, I'm supposed to mention this because I was told to earlier, is I gave you guys last year a scholarship that you guys posted on the website, and only a couple students actually went out and wrote the essay. I think two did, which is unfortunate because this year, less than 10% of the entrances we had compared to years past. It would have been a good year to almost win this scholarship. But I'm sending it back in. You guys will post it again, she said. But it's $5,000 to the grand prize winners, $1,000 to the regional winners, and it's a merit scholarship. So it's based on how well you write a 500 essay, what college means to you. And we'll repost it. But if you're a freshman, you're able to do it freshman, sophomore, junior, senior year. And the reason why we open it up to freshmen is it gets you writing essays. Nice. It gets you writing essays. So by the time you do your senior essay, it's a very powerful essay. So I'll resend this over, and she said she'd post it.
Great. So guys, Patrick is talking about a scholarship, that students can get. So please try to ask your students or children to write it. It's a good exercise. Plus you can always use that extra money. I will be forcing my children when they come at that age. So thank you once again. I'd like to thank both of you for a great session today. And thank you for the time, and thank you to all the attendees for being patient and sort of understanding this and asking some really good questions. Have a great evening, afternoon, I would say, and then hopefully we'll see you guys next month. Yeah. Take care, guys.
Everyone.
One thing to actually add.
So hold on, Ramenji, what happened?
Yeah, just one last thing to actually add here. So this is actually a series of the College Connect seminars that ISW has been hosting. So I would highly encourage all of you to take advantage of this. We have our next series coming up on June 12th, I believe. We are still finalizing the logistics of this, but stay tuned. Keep a watch on your emails. You will definitely going to find this information very useful. So feel free to take advantage of this, I would say. And thanks again, everyone, for joining the call. I hope you find this information useful. Thanks to Kanan and Patrick as well, and Magji. Thank you.
Sure thing. All right, guys.
Thanks, Ramendra. Thank you, everyone. Bye, Bye, Patrick.
Yeah.
Thank
Bye.
you.
Ramenji, we can hang around for a minute. And if
Sure.
Kanan and Patrick, you want to hang around, that's okay too.
Sure.
We can.
I think other folks can feel free to drop.
Yeah.